What's up, guys? In today's video I'm going to be breaking down the 3 different types of spenders. You see, most of you probably think that there's only 2 ways to buy the big things throughout our life, and that is to be going into debt or saving up your cash. And most of you probably think that saving up your money is the way to go and that those people are winning. But I'm here to show you a different way, a way to think differently, and possibly save you more money throughout your life just by simply switching the way that you purchase the bigger things throughout your life. So without further ado, I'm going to jump right in and share with you the 3 different types of spenders. So the first and foremost, as you all know, is the debtor. Most people know how to buy things this way. You go and you buy, let's just take for example a car. You go into debt, you finance it, you pay an interest on it. And then the next one is a saver, someone that saves up cash to buy something big like a car or something like that. The mindset is that they're not having to pay the interest. Like I said, everybody would agree that they think that the saver's on top. But what most people don't learn about, and what we're going to learn about today, is the investor mindset and how to take advantage as an investor and come out more on top than a saver would. So I'm just going to go in a little bit deeper. We're going to use the example of a car. So in this graph here, we're basically picturing what it's like to be a debtor. A debtor is someone that finances everything they buy and pays interest as well as opportunity cost of that money that they're spending. So every time you spend $1, there's an opportunity cost really attached to that dollar. It's losing the amount of interest that you could have earned on that money forever. When you spend $1 at the store in cash, you might think that you're doing something good by not financing that dollar, but in reality, you're spending the interest that you could have earned on that dollar. So there's always a cost to everything, a hidden cost that nobody really sees in the moment that is crucial to understanding if you're going to be building anything of value in this world, and that's opportunity cost. So as a debtor, there's a lot of things that need to be considered. I mean, there's a lot of risk involved. You're basically saying that if the market tanks, like let's say you go finance a car or a house, that's what many people do in America, and the market takes a turn and you lose your job and you can't make up with the payments, so then you lose that thing. That's where foreclosures and repossessions of cars come in to play, is when those things happen. So you need to understand that when you finance things, yeah, it might be nice, you're getting a low monthly payment, you're not having to come out of cash, but there's a risk attached. You could lose that item. It's not necessarily yours. It's the bank's until you get it paid off. And again, there's an interest expense attached to this. You're going to be paying interest every single month, and you're going to be overall paying more for that vehicle. So you can kind of see over the next 4 years, this is somebody who's a debtor. They learn to basically go into debt to finance the things that they need in their life. And again, I'm going to show you how we're not going to change anything. Everybody needs a car every so often. We're just changing the way that we buy the things that we normally would have bought in our life. So coming up next is really the mindset of a saver, somebody that saves up their cash. In the beginning, maybe you have a shit car, a beater car, and you just save up your money until you get to a place where you can buy a car outright in cash. Now, a saver is someone that saves up money in order to avoid financing. They don't pay the interest, but they also lose out on the interest that they could have earned, that opportunity cost that we were discussing. So that's the important key there. Everyone thinks the saver's winning, but they are missing out on the opportunity cost of money, which is huge, because if you can somehow take advantage of the opportunity cost at an uninterrupted level, you start recapturing a large number that is going to make a big impact in your life. So it's something to consider. Again, so a saver is saving the interest that they didn't finance, but they're losing the interest that they could have earned. And this is an important thing to note. So the difference really between a debtor and a saver is really just discipline. is that delayed gratification, because either or, both of them are having to save up money. If you think about it, a financer might not be saving up money and then buying the car, but every single month they're having to make a payment. If they want to keep that purchase, if they want to keep that car or the house, they better be making their payment. So they're essentially having to save that money each month. They're not able to go and spend that money elsewhere, so they're saving it. So there is a level of discipline in all of these. That's what I'm saying. The discipline doesn't necessarily change. It's just the level of delayed gratification. And as you all know, in order to be a high level person in this world, a lot of times the more delayed gratification you have, the better things are. So I know this is where we're going to get into the beans and biscuits of the presentation. What you've all been waiting for is basically how to be an investor. But first, we have to cover why the debtor and saver are still they come out in a worse spot after, let's say 5 cars later, you're going to come off in a worse spot 25 years later than an investor mindset. They both end up in the same place. As a debtor, you're going to be going into debt, and as soon as you pay off the car, you're going to end up going and getting another car. And you're going to be in this cycle of always overpaying for cars, always paying interest for cars. Banks are getting rich off of you from buying cars, right? And at the end of 25 years, you're right in that same place. Probably a little worse off if you consider other factors like inflation, but we're going to make it simple. Then we're going to talk about a saver who essentially has to constantly save up their money. If they stop saving money right here into year 6, they're going to end up becoming a debtor and having to finance a car because they just don't have the money to save it, or to buy the car, excuse me. So 25 years later, they both end up in the same place at zero. So the big question is how, if we have a good mindset and can save money and have the discipline, shouldn't we be rewarded for that? Like, shouldn't there be something that says, I want to take advantage of this staircase without going down while also getting the car? That's what I'm going to show you right now. So the investor mindset is somebody that leverages guaranteed uninterrupted compounding, which is basically the 8th wonder of the world. They utilize this to avoid paying interest and financing while taking advantage of opportunity to earn interest. So you're earning interest without financing, and you're also earning interest of the opportunity cost. The way this works is that you're in an account that grows uninterrupted compounding, which is what this green line shows. If you left money in an account that just compounded forever without being interrupted, this is what it would look like. Now, in this particular account, you're able to leverage what you have in your account while it's growing without interrupting the compounding. So if you can see in this example here, all we're doing is financing the cars through our own asset, through money that we are saving. So you're still using the saver mentality. You're saving up money constantly every month. You're just doing it inside of a different vehicle. And then when it comes time to buy your car, rather than pulling cash out of the bank, you're pulling cash out of your own private bank and paying it back into your uninterrupted compounding account. That way, when you pay it back, you're actually catching up to the compounding. So when you run the 25 years, over time, compounding takes its course, you're building a gap that was not there previously. And that gap is what's going to grow substantially throughout your life, especially if you're young. Like, I'm 27 right now. So 25 years, I'm going to be 50. I have another 25 years if I'm lucky after that. If I live to 75, that's another 50 years. It's not unreasonable to think, I'm going to develop this gap. And that's just from purchasing cars. That's not talking about using that money for cash flow real estate, for investments, for business, for myself, houses. Like, this is what the wealthy do. It's called velocity banking. You're turning $1 into $2. It's not changing anything. You're remaining disciplined. You're just delaying gratification. Once this system is built, it puts all that money back in your pocket that was leaking out as a saver because of the opportunity cost, and as a debtor because you're just leaking all that interest to the banks that should have been going to you the whole time. And the best part about this is that this system, once built by you, can be passed down generation after generation after generation. So it's something that once built continues to serve no matter where you are in your life. So that's all I got for you guys today. I just wanted to break down those 3 different ones and maybe share with you something that you hadn't heard of before, the investor mindset. If you want to learn more about this concept, you can take a look over on my YouTube page. I talk about it more in my videos, or you could check me out on Instagram. There's a link. You can check out your investor DNA to see sort of how you can utilize this for yourself, at Real Dylan Shields on Instagram. In that case, love you guys. I'll see you in the next one.